Hey guys, what's up? Davey Trades here. Welcome to the very first section of my Trending Traders course. This is section 1, where we are going to go over just simple market structure, um, institutional order flow, and what actually moves the markets. So if we just take a look down here on my charts, most um, most courses are going to teach you something super basic when it comes to structure. It's going to look something like this. We're going to have a series of higher highs and lower highs and higher highs and lower highs, right? So we have your higher high here, your lower high here, H, H, low, uh, sorry, lower high here, higher high, lower high. Now you'll notice that it's moving upwards in a very simple channel-like delivery, which of course sometimes this can be the case, but generally this is not actually how order flow moves throughout the market, right? What you're most likely going to see is something a little bit more different, something more along the lines of this, right? You have your let's get my pencil here. You have your higher high, and then a little chop, breaks down, comes back up, right? Breaks down, moves back up. This is generally how markets are actually going to look, right? So it's much more different. Now, the reason why it's taught the other way is because they try to simplify trading. Trading is not actually a very simple thing to learn, right? So the reason why we're going to learn it a little bit differently is because I want to program you guys to think outside of the most basic concept in trading, right? So the reason why we have this type of flow is because of the composite operator, or I guess it would be more so like institutional money order flow, right? So whoever has the most amount of money is the one that's controlling the way that the market moves. Now, higher highs and higher lows, the reason why we have higher highs and higher lows is because we are creating pockets of, or we are creating supply and demand, right? So every time that we see one of these highs get broken, right, assuming that we're in a bullish order flow here, right? So order flow, right? We have a high getting broken, and down here we have a area of demand that has now been supplied to the market, right? So we have another break of structure to the top side and another one here, right? But inside here, we have the composite operator putting in orders, right, that are now chewing into the sell orders to create more demand and then send price higher, right? So that's how the market moves, right? It's orders getting introduced into the market, and if orders were to go below these areas, then the composite operator would be in a negative position, right? Now, what generally happens is eventually the position changes the direction of the order flow because because the move is now over, and you start to see something more like a sell-off, right? Where you would have your structure highs, structure lows, right? So if we look at this order flow here, we have a structure low, structure high, right? We break here, we leave a pocket of demand, right? Now, just so that you know, demand, just because there's a demand zone that's left behind doesn't necessarily mean that price is going to come directly for that demand zone and take off from that area. It's just simply not how price moves, right? And this has to do with different time frames. It has to do with the market fractals. There's so many different concepts that play into this type of structural order flow, right? So we have another structure high here, right? We have another break to the top side. We leave some more demand zone. So here we're under the assumption that, well, price is most likely going to come and break this high and again repeat the process so that we can catch more of a upwards move, right? But what we get is we get a shift in direction where price actually breaks through here and now leaves a demand zone here, right? So basically what you're trying to do is you're always trying to trade with the composite operator. You're trying to trade with directional order flow. You're trying to trade with the money. That's why we look for trends, because trending based trading is the simplest way to trade because you are trading with money, right? So we try not to put ourselves in a position where we can look at the market and we're always thinking that if we're in a bullish trajectory, that the next move is most likely going to be some type of bullish move to the top side, right? So we're going to start looking at the market more as blocks. So we're going to look at this as a block, this as a block, this is a block, right? And we're under the understanding that we have buy side, or we have, I don't want to call it buy or sell side liquidity, but we have liquidity pockets at top. And because we're in a bullish direction, the next move is most likely going to be some type of break through the top side of these liquidity pockets, right? Now, the reason why price breaks down like this is because, like I mentioned earlier, this is an opportunity for the market to create more orders, right? Otherwise, the market would just do something like this, right? But it doesn't really work that way, although we could use this as a trend line, and this could be the direction of the market. The market's going to move like this within this pattern, right? And what that is these are opportunities for us to get involved in the market, right? Because we don't want to take positions here, right? We want to have this as a target and the understanding that, okay, price is most likely going to target that area and break through that top side and continue its upward trend, right? So these areas where supply and demand is created, these are the areas of interest for us to get involved in the market, right? Similarly, we look at this price action. We look at this price action the exact same way bearishly, right? So let me show you an example on our actual higher time frame here. So if we look at our higher time frame, we have a swing low, right? Swing high, swing low, swing high, swing low. You could do all these, right? We're going to look at the structure high, this here, right? So now we know that, well, if we were to draw our trend lines, or if we were to draw our higher high and higher low, it's most likely going to look something like this. Here's our lower high. Here's our higher high. Here's our lower high, right? We have our liquidity that most likely will be targeted here. Price breaks down. Orders are being accumulated into the market. That's why I call this a reaccumulation of price, right? We have a demand zone that's been left. Again, remember I told you earlier that just because a demand zone is left does not mean that price needs to actually tap into that demand zone. So what we have here is we have our price start delivering bullish again, right? Good opportunities for us to look for buys, right? Anywhere in here, we get to the top side of the liquidity, right? Typically when you get to this area, you're going to see some type of rejection here, right? Again, this is a good opportunity for us to wait for price to pull back, give us some type of rejection, and then continue to the top side, right? So again, we're just following our bullish order flow, right? Higher high, lower high, higher high, lower high, but we have a breakdown in structure here. Now, in this case, this doesn't necessarily mean that this demand zone that was left, a bearish demand zone, doesn't necessarily mean that price is going to continuously break down the way that we assume that it will, right? But this is what we do as price action traders, right? Or as trending based traders. We are still under the assumption that just because we have a bigger type of pullback here doesn't necessarily mean that price is ready to continue on a bearish trajectory. And the reason is because, well, we have such how can I put this? We have so much proven bullishness here, right? That, well, the assumption is that price is most likely going to continue bullish. So in this case, even though it was a little bit of a bigger rejection, but what has actually happened is we have tapped into this area of demand, creating some areas, some sell-off areas. But because we haven't had our actual structure low break, we had internal break of liquidity, or an internal break of direction. We have our lower high here, which is our institutional area of interest, and it's tapped into our demand zone, and it's continued to head on our bullish trajectory, right? Once again, breaking this high, right? So we use this as a point of interest. We know that liquidity is sitting up here, and we are on a bullish trend. So price most likely wants to move to the top side, take out this liquidity, and continue going bullish, right? Which is exactly what happens. Now we have another reaccumulation, right? So we can look at our order flow. We have our lower high that tapped into our demand zone, continues upwards, breaks our area of liquidity. Orders are being accumulated into the market here by the composite operator, or the institutional order flow, whoever has the most amount of money, and we continue moving to the top side, right? Now here's where it gets a little bit interesting again. We have price wanting to sell off. Starting here, we get a break down to the bearish direction, we get another break bearish. Okay, this is a little bit more interesting for us, right? Because our structural lower high has now been broken. But in this case, it actually just creates a break of structure with a rejection. So this is more of like some would call this a liquidity sweep. This is something that we're going to talk about in a later video. And price continues bullish to the top side. So again, we're just looking at another reaccumulation. Now, this is a higher time frame. We are going to use institutional order flow on higher time frames, right? The reason why we use higher time frames is because big money doesn't trade lower time frames, but the market is a fractal environment, right? So, and we'll talk about fractals later on in the course. But basically, the market is just it's a repeating pattern that repeats across all time frames all at the same time, right? And it's just it's a bunch of orders being filled, and there's supply and demand zones and institutional order flow. But what we do is we are looking for higher time frame institutional order flow, or some type of move with volume in a specific direction. Again, this will be taught later on. And we are going to go down to very low time frames, and we are going to take advantage of the institutional order flow of lower time frames within a higher time frame move, right? That is trending based, and that is where we will find our opportunities within moves like, let's say, moves like this area here, right? Because keep in mind we're on a 4-hour time frame, so this area here, this is quite a large move, right? But within within this area, right, of delivery, we are going to see prices reaccumulate, come up, reaccumulate, and it's going to be doing the same thing. So we are going to just look for our basic understanding of structural order flow on lower time frames within higher time frame moves. All right, so that's our first lesson. We are going to talk more about structure and order flow and bullish bearish directions in some of the next upcoming videos. Thanks.